Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And we got Raj back on the channel, super special guest, Raj, the CEO of Evolve ETFs. How's it going, Raj? Welcome back, my friend.
I'm good, Adriano. Thanks for having me back.
I'm super excited. We have a lot of stuff to catch up on, new funds, new products. So why don't you just start by telling me how you are, how's Evolve, your company's been doing in the last year, what has surprised you? Just give me a little update on the landscape, the investing landscape that you see.
Yeah, it's been great. Many of your viewers are probably heard of us before. Hopefully they have.
For
Uh,
sure.
we started just over 7 years ago when we launched our business. Today we're closing in on $7.5 billion. We're just over 7.4 billion in assets. I think we've been, if not the one of the fastest growing ETF providers in the country, and I think that's got a lot to do with the fact that we've been very thoughtful about the types of products that we've been able to bring to market. And we've also had some fantastic performance in a number of our funds as well. And as you know, performance is a big ally as it relates to assets. So it's been great. We've come up with a lot of first of their kind in the Canadian market. We've also taken some traditional products and put little twists on them to try and make them a little bit better. And yeah, it's been great. I mean, the covered call lineup for us has grown significantly. Of our 7.5 billion, about 1.5 billion is in covered calls, covered call funds, I should say. Of the 30 funds that we're managing, about 12 of them are actually covered call funds as well, or funds with a covered call overlay. So it's been great growth. 1.5 billion, 12 funds, and actually almost a billion of those assets have actually come just in the last year alone. So
Wow.
when we
Okay.
when we look at our covered call funds, um, we kind of put them into three categories. When we first started the business, as I said before, 7 years ago, we started out by focusing in on some sector specific funds with a covered call overlay. So Life, which is our global healthcare fund, which is also one of our largest covered call funds, very much focused obviously on global healthcare, and then put an active covered call overlay on top. US banks as well. We did that with global materials and mining. And then as time kind of went on a few years ago, we decided to also start to get a little bit into core beta strategies, because what we found was a lot of investors and advisors, they didn't necessarily want to try and pick a sector. They just wanted to have the broad market. And
Yeah.
so we launched actually the first S&P 500 with covered calls ETF in Canada, and we also launched the first TSX 60 ETF with covered calls as well, and those have done incredibly well and gathered a lot of assets. And then finally, we got into this whole new category, which I know you've covered on a few of your shows as well, which is covered calls on fixed income, and we've seen a lot of flow go into that fund as well.
Yeah, so you covered a lot there. Thanks for that big, nice general update. So we're gonna actually, since my channel's, focus is really about income, we're really gonna focus more on the covered call ETFs that you guys run and manage. So maybe we could start with before we get into really specific fund, we'll do more general stuff before we get into more the specific ETFs, which you mentioned many of them already. But in terms of the Evolve's view of the actual, cover call strategy, what is your right level? Like how much of the portfolio are you writing? I know some of it, sometimes it's different for each fund, but what's Evolve's view in general regarding covered calls? How much, which is basically, how much upside you're giving up. But what would you say to that?
Yeah, I think, it's a great question because there's a lot of factors in play when you're looking at a covered call fund. You're looking at what kind of option premium you can generate over how much are you covering. You're
Yeah.
looking at natural dividend yield of the fund. You're thinking about over an entire market cycle, how much overall yield you can generate. And then you're also, the other side of it is, you know, um, satisfying investor appetite as well. What kind of yield an investor is going to need or want from the product, and that helps dictate how much potentially we're going to cover. And as you know, and you just said, the more you end up covering, the more you're potentially capping some of the upside of the investor. So there's never a free lunch, right? I mean, one of the trade-offs of covered call strategies is that you are capping some of the upside, but you're getting tax efficient income in exchange. So when you put all of that together, you have to really give some thought as to what makes the most sense from an investor perspective. So for most of our funds, our covered call funds, we limit our covered calls to about 33% of the portfolio. We do have a couple where we limit it around 50%, and part of that is because we recognize the need for yield, and potentially that asset class has a lot of upside, and so maybe we're okay, or investors are okay with capping a larger portion of that upside.
Okay, right.
So there's a lot. It's a lot of science that goes into it, but there's also some art as well.
Yeah, it's a really fine balance, right? Trying to find that perfect right level, the moneyness of the options. You mentioned tax efficiency as well, and that's because in case my audience doesn't know, but most of them do know, of course, because they're very smart people, obviously. So covered call premiums, when you're generating those premiums, those are classified as capital gains in Canada, correct?
Yeah, that's right. And that's kind of one of the reasons why. I mean, I would say that there's two primary reasons why covered call funds have really resonated in the Canadian marketplace. I think right now we're up to about 25 billion in covered call funds in terms of assets in the Canadian market. And it's the need for yield, no doubt. Investors are in Canada, I would say, are a little more yield oriented than investors in other parts of the world, specifically the US. And as you said, it's the tax efficiency of that yield as well that's really driving a lot of demand. I mean, this year alone in the covered call space has been the biggest year yet. I think just over $4 billion has actually gone into covered call funds, which and we still have a couple more months or a month and a half left to go in this year. So it's not even finished yet. But the previous record was about 3.8 or 3.9 billion. So you're definitely seeing investors striving for tax efficient yield, no doubt.
Yeah, yeah, it's fantastic. It's a fantastic tool for generating income. Obviously, my favorite tool. Okay, so there's a lot of competition in Canada. So you mentioned, the numbers, the AUM, the assets that are going towards covered call type strategies are exploding. It really exploding in the US as well the last year or two. What would you say makes Evolve? What makes you guys different from your competitors, which you have more and more of now, right? So
Yeah.
what makes you stand out?
I think the last stat that I saw was there's been more than 50 new covered call funds that have launched in the Canadian marketplace. So it's definitely increasing in competition. And on the one hand, you could think of that as it's a challenge for investors because it can be quite confusing to decipher which funds they should be investing in. But on the other hand, it's an opportunity because it means more choice. I've always been a big believer in more choice creates better efficiencies as well. So at least you have lots of options as a Canadian investor. When we structure our covered call funds, it's kind of a two-pronged approach. The first is what sector or what market do we want to give the investors exposure to? The next part is what would be the best way to actually give them that equity exposure. We do not actively manage. We have one fund that we actively manage, but all of the others, we do not actively manage the equity, or in one case or two cases, the fixed income portion of the portfolio. What we will do is we'll take a look at creating an index and provide investors with exposure to the top 10 or top 20 companies in that specific sector. We'll typically equal weight it and then rebalance on a quarterly basis. So, for example, Bank, which has been one of our most successful covered call funds, we're not making a call that we want to own more Royal Bank right now versus TD because we think Royal is better. We don't do that. We are not active in our equity approach. We just take an equal weighted basis approach to it. But where
Yeah.
we are active is in our covered call overlay. And
Uh-huh.
that to me is where we really differentiate ourselves from our competition. And in a previous life, I ran the retail business for one of Canada's largest asset managers called Fiera Capital. They currently manage, I think, about $200 billion, and I ran the retail business for them. And one of the guys that I worked with back then was Steve Pate. And he was one of the derivatives traders, options traders at Fiera. And I remember sitting with him and thinking, wow, this is one of the first people I've ever met, or managers that I've ever met, that's actually been able to consistently make money for their investors using options. So when I set up Evolve, he was one of the first people that I reached out to because I knew I wanted to launch covered call funds in the Canadian marketplace, and I knew how good he was. And so he agreed to join me at Evolve. And then since then, we've obviously been able to build an entire team around him, but he's just done a phenomenal job. Where we differentiate is within the active side is his ability and the team's ability to kind of navigate the markets. And let me explain what I mean by that. We have the ability to go up to 33%, or in a couple of cases, 50%. That doesn't mean that we have to go up to that level. There's going to be periods of time where we want the investor to be able to capture more of the upside growth of that specific market. And there's going to be times where we want to generate that income and at the expense of potentially not capturing all of that upside as well. February 2020 was a great example, and everyone remembers that period all too painfully well, which was in the middle of COVID. And as you probably remember, in February of 2020, we had a big sell-off in the equity markets, and then in March we started to see a recovery. And what Steve and his team kind of looked at that point is it didn't make sense to load up on options at that time because the pricing wasn't great, and you could clearly see some light at the end of the tunnel from an equity growth perspective. So he really dialed down our calls. Like there was, a couple of our funds, we had less than 10% covered, and it gave investors more upside.
Right.
So those are the types of periods where you can really generate some alpha. Because remember, there's a lot of things that go into option pricing, right? I mean, volatility is one, but there's also mispricing that takes place in the options market. So when you have somebody that is really plugged into that space, it can be very helpful from an alpha generation perspective. A lot of our competitors, they utilize a systematic approach. And I think most of your viewers know systematic, but just in 30 seconds, systematic means if you're writing on 33%, you're writing on 33% of every stock that's in that portfolio. You're typically rolling on a monthly basis. There's no discretion that's going into it. It's almost like a mechanical or a robotic strategy that takes place.
Yeah, I call it a rinse and repeat.
That's right. Yeah. So we believe that an active strategy actually makes a lot of sense, and we've been able to prove that out. Many of our funds have actually outperformed a systematic approach by about 1.5 to 2.5% on an annual basis, net of fees. So active really works. So again, we kind of take a passive approach in the security selection, and we take an active approach on the covered call strategy. And I think when you do that, you're playing towards the probabilities, meaning that I think most people know that most active managers underperform their benchmark.
Yeah.
So why should we even try to be active managers on the security selection side? And the flip side of it is there's a good number of managers that outperform actively on a covered call strategy. So we decided to move towards that probability. So it's been working really well for us.
A lot to unpack, Raj, a lot to unpack there. So maybe we could use bank as an example to tie a lot of this information together. So correct me if I'm wrong, bank, I believe, is now your biggest in terms of AUM cover call strategy, just past Life, which is the second biggest, I believe. So you just cracked here over 300 million. So going back to where you're
bond
seeing,
is right there. Bond is right there as well.
Bond as well.
Bond and Life are pretty neck and neck. So all three of those funds are hovering around 300 million in assets each.
Yeah, we'll get to, I'm going to try to get to all of them. Hopefully you have enough time for us this afternoon because I got all the time in the world. I could talk to you all day. So let's focus on banks. So you're saying one thing I want to, just touch base and show the audience. So you're saying you're passive when it comes to the stock selection, but active when it comes to the covered call strategy. So I did notice this, that you guys mostly use indexes and you're
We do.
not picking and choosing stocks. So for example, let's go with bank, but even other ones have, a selective index. This is an
Mhm.
index you guys are coming up with in bank is the Selective Canadian Core Financials Equal Weight Index. So correct me if I'm wrong, it's the top 10 in terms of AUM, I believe,
Yes.
biggest financial companies.
Yes.
So you're looking at the big six banks, Manulife, Sun Life, Great West Life, and Power Corporations, equal weighted, like you said. So about 10, obviously 10 companies, about 10% each, and you're rebalancing quarterly. So you're not playing around with the stocks. So if we go to the holdings, obviously it's those 10 stocks that we talked about here.
Yeah, and
But
just one clarification, it's not
sure,
just on financials. It's the banks and the life cos.
banks and life cos. Okay.
That's right. So
Well,
it's the big six banks plus the big four life cos that are in the Canadian market.
okay, sounds good. So this is what you mean by a passive approach for stock selection, but an active approach when it comes to the covered calls. And one thing I did notice, I have to give you props for it. If you go to portfolio, you could actually see all the calls that
Yeah,
I'm assuming Steve is writing.
yeah,
Who's there he is right there, Steve Pate, right? The guy you were
yeah,
talking about,
yeah,
your head of trading, it seems here.
yeah.
So not a lot of fund managers will actually tell you their call options, what they're doing. You're putting the dates, you're putting the obviously full transparency. The strike prices are there as well. You see the strike prices here.
Yeah,
So
listen, I think, the more information that you can give investors and the more transparent you can be, the more educated of a decision the investor can make in terms of deciding whether they're going to use the fund or not.
yeah, no, that's great. I really appreciate that. I like looking at the call options, and then I look at the stock price and I see, oh, I still got a bit more room or whatever. It's pretty fun. So if we just stick with bank is your biggest covered call ETF right now.
Yes.
It's doing pretty well against the competition. There's a lot of competition in Canada
Yeah.
specifically for financials. It's
Yeah.
actually outperforming the competition. Why do you think that is?
Well, a few things. One is I do think a passive approach to equity selection makes more sense, and 9 times out of 10, you outperform an active strategy. So that's one element. The other side of it is that the banks have had a pretty good year. I mean, our fund, I believe, is up about 27, 28% so far this year. So they've had a nice run. And I say this all the time. There are two types of companies that I would never bet against. I would never bet against the Canadian banks, and I would never bet against big tech as well. And I think if you follow that philosophy and strategy over the long term, it can deliver a lot of fruits to your portfolios. So I would say that those are the reasons. And then with this fund as well, we do have 25% leverage. So you've got the portfolio, and then you've got the covered call overlay, and you've got 25% leverage. And a lot of investors like leverage because it can obviously enhance overall returns. But of course, leverage is a double-edged sword. On the way down, it can also amplify some losses. So it does provide a little bit more volatility. But when we think about leverage, we think about the correlation between the cost of that leverage and the performance of the underlying basket. And
Mm-hmm.
so, for example, today as everyone knows, we're moving into a lower interest rate environment, which means that the leverage cost is going to decrease, but it also is positive for the portfolio typically because banks perform better in a lower interest rate environment, partially because people will go and take out more loans and more mortgages and so on. And also you tend to have lower default risk from a loan and mortgage perspective as a bank. So we're always thinking about both sides and trying to make sure that we're putting products together that if they have different forces in play, that there's some level of complementary to them. So I would say those would be the primary reasons why that fund has done so well.
Yeah, and I mean, I'm someone who doesn't
And the
like bet.
yield. I mean,
Yeah.
the yield is always important, and the yield for that fund is, I think, just over 15%. So that has obviously been extremely attractive for a lot of investors as well. And part of the reason why the yield has been high is because you've got a good dividend yield in the portfolio. You have good call premiums that you can generate, and then you have 25% leverage on top, which obviously expands on the yield as well.
Yeah, I don't like leverage. I love leverage. I'm a huge fan. I love that it's modest 25% leverage. It increases the yield, the performance over time. Of course, like you said, it's a double-edged sword. But when I buy something, I hold it for a long period of time. So for me, it's great. I own
Yeah.
bank myself. It recently increased the distribution as well from
Yeah.
10 cents to 11 cents. So before we get into maybe other funds, maybe we could stick to what makes you guys determine the yield, right? Because from looking at all your funds for a really long time, I see that you, correct me if I'm wrong, I've never seen a distribution decrease. I've only seen increases, which is fantastic for income investors. So tell me a little bit about the way you guys think about distributions, how to set them, why would you
Yeah.
raise, what makes you give, what gives you the ability to raise a dividend? What would you say about that?
So what we will do is we will think about every fund throughout an entire market cycle and what the current dividend yield would be of the underlying portfolio, what kind of premiums we can generate today off of the covered call overlay, and then what's the impact of leverage on top as it relates to bank and a new fund that we launched, UTES, which is Canadian Utilities, are the only two funds that we have that have leverage. And then the other funds do not have leverage. The other covered call funds do not have leverage as well. And so when we look at that entire package, we'll say, over an entire market cycle, do we feel confident that we can generate that yield? And what ends up happening inevitably is there's going to be periods where you're going to underachieve on that yield. And there should be periods as well where you're going to overachieve, where you're going to generate more yield than what you're paying out. We also kind of follow an approach where we fix our distributions to investors. So our belief in that is that investors want consistent income. And even though there might be periods where you're not going to generate that yield, but then other periods where you are going to generate that plus more, we feel that we need to smooth it out and we need to provide that consistency of cash flow to investors. So some of our competitors, they may do it on a variable basis, which means that the yields go up and down as well. We've decided to take a little bit of a different approach and just pay investors a fixed distribution so that they have that consistency and most importantly, that predictability. But there's a lot of things that go into the thought process of how we set our distributions. We actually, every month, we sit down as a team and talk about what kind of yield was generated for the portfolio and whether we should be looking at adjusting our yield upwards. We to your point, we have not been in a situation where we have decreased our yield or our distributions yet, so very fortunate. But we are obviously also looking at whether we could potentially increase it and maximize that yield for investors. So there is a lot of work that goes into it, and there's a lot of inputs that result in the output.
Sounds good. No, that makes total sense to me. Of course, cover call premiums vary greatly month to month, depending on NAV, depending on volatility as well. So that makes complete sense. So you've talked about it, and this is another one of funds that I own myself personally as well with bank. Obviously, I just told you I love the leveraged ones. UTES. So I don't
Yeah.
know. That's how I say it. It's UTES, whatever it is. It's the Evolved Canadian Utilities Enhanced Yield Index Fund. So I'll just introduce it briefly. Very similar to bank in terms of it has 10 holdings as well, equal weight. Again, it's based on an index, the Selective Canada Utility Index. It's pretty cool because it's actually diversified within the utility sector. So you have actually, electricity generators like Fortis, Emera, I believe is in there. Yeah, Fortis, Hydro One, Emera. So you have 40% in electricity or utilities, and you have 30% in the top three biggest pipelines. So Enbridge, TRP, etc. And then you have the telecoms, Bell, Telus, Rogers. So tell me a little bit about UTES. Why did you guys decide to launch it? It's already at 50 million, so obviously very, very, very popular. What can you
Yeah.
tell me about this one?
Well, so first of all, we take a lot of pride in our tickers. I think we come up with some pretty good ones. I mean, Bank obviously is really good, and Bond. I don't know how we were able to get Bond as a ticker. And Utes was kind of obviously it's about utilities, but I liked it because it reminded me of the scene in My Cousin Vinny, if your viewers remember it, where Joe Pesci was referring to the two kids as the two Utes with his Brooklyn accent. And so we kind of liked it. You know, I've realized a couple of things, and I realized this a long time ago. I mean, I really do wish we launched this fund a while ago, but I realized a couple of things that Canadians have a home bias for a few areas within their portfolio. They have a home bias for their Canadian banks, for
Hmm.
sure. They also have a home bias for Canadian fixed income to a large degree. Most of their fixed income portfolio tends to be in Canadian bonds. And they also have a home bias for an area like utilities. And part of it, I think, is the ability to relate to these companies. I often say, you know, these are the envelopes that are sitting on your counter that you have to write checks for
Your
to
bills.
pay the
Yeah.
bills. Now, I know I'm dating myself because most people don't even have a checkbook anymore. But my point is that these are the companies that you're paying. These are on a monthly basis. And I often say that if you're paying these companies and everybody else is paying it, maybe it makes sense to own the stocks as well. And that was kind of the approach that went into this fund. What I also really like about it is it's very recession resilient because look, no matter what, you have to pay your Rogers bill. No matter what, you have to pay your heating bill. You have to pay your electric bill. These are all important utilities that you need for survival or for living. So in a difficult economy, it's not as though their revenues are going to come down. What I also like about the utility sector, this isn't just about the Canadian utility sector, but all utility sectors, is as we're in this decreasing interest rate, declining interest rate environment, that's beneficial for companies that are in the utility sector because they invest a lot in their infrastructure. It's a very capital intensive business. So the lower the interest rates are, the lower their borrow cost is in terms of lending, in terms of borrowing to fund those projects, which means that it results in better balance sheet for those companies. So we really like this sector. It's very core. It's very recession resilient. It benefits from a declining interest rate environment, and it's all the names that you know. And as I said, that you're paying your bills to or setting up on your online bank to pay every month. And yes, it's the other fund that we have that has 25% leverage as well. And yeah, it's been going really well. I mean, getting to $50 million. I haven't looked close enough to figure out, but I'm pretty sure this might be one of the fastest that we've gotten to 50 million in one of our funds. Fastest period of time to get to $50 million. Just a lot of investors have really gravitated towards it.
Excellent. Let's talk about bond. So bond is your long-term U.S. government fixed income ETF with a covered call overlay. Like you mentioned at the beginning, I think most of them have up to 33%. This one has up to 50%. And this one's been out for over a year now. It's got a really nice 12-month trailing yield of about approximately 11.55%. It's grown really, really big, and it's actually outperforming its competitors. So you have a couple of competitors, actually three that have a very, let's just say, very, very, very similar strategy, similar holdings. Bond is beating them. So tell me what you think about this one and why you're outperforming, you think, the competition. Does it go back to to Steve Pate and his genius cover call strategy?
Well, I don't want his head to get too big. But he's definitely contributing to that. There's no doubt about it because many of us are investing in the same underlying portfolio. The only difference between us is how we're running our covered call
Right.
strategy. So really, it has a lot to do with Steve and the team, the way they're generating the alpha compared to the competitors. Let me tell you a little bit about kind of this product because it's a very new category. Um, and I find it to be extremely interesting as well, because what what many people are not aware of is that there is no options market available on bonds, on fixed income.
Hmm.
but there is an options market on big liquid ETFs.
Right.
Whether
Like
the ETF
TLT.
has TLT, whether the ETF has fixed income as the underlying or whether the ETF has equities, it's more about the ETF wrapper and is there an options market available to it. So we saw this product in the US. TLT is 20-year US Treasury. Depending on the day, it's somewhere between 40 and $50 billion in assets. And then iShares launched in the US a fund called TLTW, which was writing calls on TLT.
Yeah.
And we looked at that and we kind of had this little light bulb moment. And we said, this is really interesting because I know a couple of things. I know that if this is resonating in the US, this really could resonate more in Canada because in Canada, we tend to be more yield oriented than Americans are. We're a little bit more conservative than Americans are. But also, as we talked about before, covered call premiums are taxed on capital accounts, so it's very tax efficient in Canada. So we looked at that and we thought we have to bring this product to market in the Canadian space. We'd also been going through an exercise over the last couple of years of making sure that we have a very diverse product lineup because we knew that at some point, like one of our big funds is our HISA fund, which is a cash alternative product. We knew at some point money was going to leave that fund and get deployed back into the market. What you never really know, because nobody's crystal ball is perfect, is it going to go into equity strategies? What equity strategies is it going to go into? Or is it going to go into fixed income? Fixed income has been a very, very painful asset class
Tell me about it.
for investors, for you, for me, for advisors, for their clients, for everyone. But not enough attention goes to the opportunity cost of that fixed income. And let me explain what I mean by that. If you follow a traditional 60-40 model and you have 40% of your portfolio in fixed income, that means that you've had 40% of your fixed income, of your portfolio in fixed income over the last 10, 12 years in the best equity market run that we've had in history.
Yeah.
And so that 40% that was sitting in a dead asset being fixed income, and in some cases a negative asset being fixed income, also meant that that 40% was not in equities. So you missed out on all of those returns. So people have been very, very annoyed by fixed income within their portfolio. But some are now saying, times are changing and rates are going down. That should be positive for certain fixed income or generally fixed income. And a lot of investors have said, I want to, if I'm going to do this, if I'm going to invest back in fixed income, and if I believe we're going to be in a declining interest rate environment, then I need to extend out my duration in my fixed income. So obviously 20-year US Treasury is pretty long dated fixed income and obviously incredibly high credit quality because it's US Treasury. So we caught it at the right time. We launched the fund just over a year ago. And what we do with that fund is we buy TLT,
Hmm.
and we also buy VGLT, which is the same thing as TLT. It's just Vanguard's version of it, and it's a little bit
Right.
cheaper, so it brings down the overall cost of ownership for the investors. And we write on 50% of that position, and then we let the other 50% obviously roll with the performance of whatever the underlying asset is going to be. And what a lot of people are not aware of, and this is very kind of surprising for some, is that the volatility of US Treasury has been incredibly high. To put it into perspective, over the last year or so, the volatility for 20-year US Treasury has been as high or higher than the NASDAQ 100. You're talking about
Wow.
US Treasury. You do not expect that kind of volatility, but it has been. And as we've talked about before, and as you and I have talked about previously, volatility is an option trader's best friend, which means that the more volatile in asset classes, usually the higher the covered call premiums you can generate. That's exactly what's happened. So with this fund, right now the underlying yield is about 3 to 3.5%, but we're able to generate about 7% of option premium off of the position. So you're effectively paying out to the investor 10, 11%, of
Hmm.
which the majority is tax efficient because it's taxed on capital account. So for a lot of investors right now that are thinking about going back into fixed income because of pending rate cuts, They want to take long duration. They don't want to take unnecessary credit risk, but they also want to have meaningful yield. So this fund checks all of those boxes for them, which is why it's grown in a year to about 300 million in assets.
Awesome, awesome, and congrats on beating your competition with
Thank you.
basically similar.
We won't let Steve see this presentation.
We'll give a shout out to Steve. All right, perfect.
Yeah.
So what about AGG? This is a newer one along with you. It's a newer covered call ETF, also fixed income, but on Canadian government bonds, I believe. Tell me about this one.
Yeah, and actually first of its kind, and right now only one of its kind in the Canadian market. When
Hmm.
we looked at what we were able to do with bond around U.S. Treasury, we've been trying to figure out ways to replicate that success with other strategies. And I mentioned before, there's a few areas that Canadians have a home bias towards, and that is the banks. That's a sector like utilities, but it's also fixed income. I saw a study from TD a while ago that said that 72% of the fixed income ETF holdings is into Canadian fixed income holdings. So Canadians don't tend to buy a lot of US. They don't tend to buy a lot of EM debt for sure. They tend to not buy a lot of global bonds as well. They really like their Canadian fixed income. So we said, well, why don't we apply this strategy to Canadian fixed income? So we took a look at ZAG and XBB. Those are the two big Canadian aggregate bond ETFs in Canada. So it tracks the FTSE Canadian Bond Universe Index. And there were options available on them. And we went and talked to a couple of the banks, and the banks agreed to partner with us. But we
Awesome.
also knew that you're not going to have the same volatility that you have in U.S. Treasury. There's a lot less volatility in Canadian aggregate bonds than there is in U.S. Treasury. So we weren't going to pick up that 7% like we're picking up in the U.S. It's going to
Right.
be a lot less. But if we can generate a little bit more than what they're already getting off of that Canadian fixed income, then and on a tax efficient basis, then I think we have a formula for success. So we launched that fund, I guess, a couple of months ago. The reception's been really good, but people are trying to time their entry into an area like that. So I think that next year, I hope that next year, the fund has a lot of success in terms of performance and growth.
Okay, so similar strategy to bond, except it's in the Canadian fixed income market, and it's in these two ETFs, ZAG and XBB, and you're writing cover calls on these. But this is not specifically just government bonds. This is Canadian universe and aggregate.
Investment.
When I hear aggregate, it means like a lot of different bond type instrument, provincial bonds, Canadian government bonds, maybe some corporates, maybe some mortgages. So this is more of that's what I'm seeing is the difference between bond. Bond is U.S. Treasuries. This
You
is
got it.
more overall Canadian bonds.
That's
Do I have
right.
that right?
That's right. You got it.
Okay. Awesome. Just another option. Let's talk about tech now. One of my favorite sectors, and I believe yours as well. So you guys came out with a very interesting uh, technology covered call ETF. That's really different from the competition. So there's many pure play technology covered call ETFs in Canada where they're picking 10, 15, 20, 25 maybe technology stocks, writing calls on those. This one's a bit different. This is index based. So you're basically, correct me if I'm wrong here, and I'll let you
Yep.
explain it. You're taking the NASDAQ 100, you're kicking out all the non-tech companies, and that's bang, that's your index here. That's the ETF. So you have 43 companies instead of 100. You have basically all the technology stocks in the NASDAQ 100, and it's market cap weighted. It's not equal weighted, which means obviously the bigger the company is, the bigger the percentage. So tell me who came up with this fantastic idea.
Uh, yes, I love this idea, and I'll tell you why I love this idea. It takes something that is core to a lot of investors,
Yeah,
being Nasdaq 100,
yeah.
and it puts a little twist on it to make it better, and it's easy to explain, and so it kind of has checks a lot of those boxes. So I was in Miami for an ETF conference a couple of years ago, almost 2 years ago now, And I was having lunch with the Nasdaq, and we were just talking about FANGMA or magma stocks and how much of the market performance they've driven in terms of the S&P 500 and the Nasdaq. And I asked them a question, and I'm so glad that I did. I just said, out of curiosity, how many of the companies in the Nasdaq 100 are actually technology companies? And they said, it's funny you ask us this because most people are unaware of this, but only 40 of the 100 in the Nasdaq 100 are technology companies. And I was like, that's interesting. Now, those 40 do make up about 60% of the market cap of the index, but that still means 60 names and 40% of the NASDAQ 100 is non-tech. And then I thought to myself, well, I'm willing to bet that 99% of investors that allocate money to the Qs or to any other NASDAQ 100 ETF are doing so to increase their exposure to technology. They are not doing it to increase their exposure to Pepsi, Marriott, Costco, Lululemon, Starbucks. Those are some of the companies in the other 60 positions. And I thought, well, it would be interesting if we just provided the investors with just the technology component, those 40 companies in the NASDAQ 100. And the Nasdaq said, yes, we love that idea. In fact, we've been running an index for the last 10 years exactly on that premise. And so I asked them to send me the index data, and they sent it, and it looked fantastic, and it outperformed the Nasdaq 100 over almost every period because obviously it's a little more tech heavy. And I said we have to launch this in Canada. So we partnered up with the Nasdaq about, I guess, just over a year ago when we officially launched it. And then we also recognize that a lot of investors want to have a yield component, and as many of you know, there's not much dividend yield in technology stocks. So we decided to do a covered call version of it. So the non-covered call version is QQQT, and the covered call version of it is QQQY. We cover up to 50% of the portfolio. Both have sold pretty well. Both have obviously performed extremely well. So I really love that story. A lot of people I love it because I always see a raised eyebrow when I mention to people that only 40 of the 100 stocks on the NASDAQ 100 are actually technology because they assumed that it was all tech. And when you think about it, the NASDAQ 100 was actually started in 1985. It was started to be a non-financials index.
Yeah.
And so if you strip out financials, what ends up happening by default is because of the growth in the technology sector, is you end up being more weighted towards a sector like technology, because technology is the first biggest sector in the S&P 500. So of course that's going to happen. But when you think back to 1985, there was barely any technology companies around. It's just grown over the last 10 years. So there's a lot of misconceptions in the market. And, I think it's always good when people get educated on how products work. I think I'm very surprised that I didn't know completely that there was this little tech exposure in the NASDAQ 100. And I believe that, 99% of people out there didn't know that. And still many of them don't know that there's a lot of non-tech in the NASDAQ 100.
Yeah. 1985, the year I was born. That's a sign for me. And
You're
I think,
you're a lot younger than me, Adriano.
well, the Nasdaq 100 is probably my favorite index. I mean, it's
Yeah,
just
well, I mean,
awesome. It's
it's basically been the best performing
yeah,
major index in the world for the
yeah,
last 10, 15 years. So I think it should be
yeah.
everyone's favorite.
Yeah, and like you said, I mean, it's very, very technology heavy. It's maybe 55% technology, but the rest is other stuff like Pepsi and Marriott and some healthcare companies, etc. So okay, so QQQY is your covered call version. QQQT, same thing without the covered calls if you want that pure growth. So that's
Right.
absolutely fantastic. So one question, so why don't you have a leveraged version of QQQY? I mean, the yield is really great. The trailing is a little over 13 here, almost 13 and a half here. Of course, that could vary based on a share price, of course, but why not a 25% leverage version of QQQY? And by that, I mean, please, please, please.
Uh, we are looking at everything. I mean, I obviously can't talk too much about,
I
our
understand.
product development plans. But look, I can tell you this, that our success in having modest leverage in products being bank and Utes it definitely nudges me and our product development team to be doing more of that type of thing. So everything is on the table. We look at this, all of this on a regular basis.
Okay,
Is
perfect.
that a good non-answer for you?
That's a great non-answer for me. I know that I know you can't talk about that kind of stuff anyway if there is one. But yeah, congrats on the success as well.
Thank
Really,
you.
really solid performance compared to other, covered call technology. I really like that it's market cap weighted. I like that
Mhm.
instead of equal weighted. So the big boys, the Apple, Microsoft, Nvidia get the biggest chunk of it there. So I want to talk to you about your fees now, your management fees. So
Okay.
QQQY, for example, I'm just going to go through a few of them real quick here. 50, where is it? Here it is, 50 basis points. You
Mhm.
have your two index-based ones, your ESPX, which is S&P 500 with covered calls, up to 33. You have the same thing on the TSX 60. They're both at 45 basis points. So the usual typical covered call ETF management fee is Canada is typically 65 basis points. You guys are at 45. QQQY is at 50, where normally it could be from anywhere from 65 to 85 basis points. Even your leverage ones, I mean, bank and Utes are at 60,
Yeah.
right? 60 basis points, where normally they could vary, leverage ones vary between 65. I've seen 8 until 85. What makes you guys have these lower management fees versus your competition? I'm just curious.
Well, we look at everything. I mean, we look at the landscape. We look at the work that goes into these funds as well.
Hmm.
There be any security selection. Obviously, for the most part, we don't have security selection, whether it be the covered call strategies. I mean, for some of these funds, like for example, when you look at the S&P 500, there's 500 stocks in the S&P 500, and there's a lot of call options on a lot of those stocks. So there is quite a bit of work. So we kind of look at all of that and we say, how do we be competitive as well? And we never want the decision to come down to that, our fund is more that investors like our fund better, but it's more expensive, so they don't necessarily want to do it. We want to check every box for an investor, right? We want them to really like the idea or the concept behind the product or the sector. We want them to like the structure and the construction and the covered call strategy, and we want them to like the fee. I mean, we want everyone to have a really good experience with our products. And so far, I think we've done a really great job of delivering a good experience. I look at all of the most successful companies out there, and especially the big tech companies, whether it be the Googles, the Apples of the world, and Amazon, for example, is one of the reasons they're so successful is because they deliver a really great client experience and really great client service as well. And we kind of want to emulate that within the ETF business. And I think so far we're doing a pretty good job.
I think so too. I mean, what's really, really important, the feedback, not only from myself as a pure income investor, but also from the community is one of the most, if not the most important thing, is the consistency of the distributions and that they're not reduced because that's what literally people are living. Some people are literally
Yeah.
living off of this, so it's very, very important. So I have to give kudos to Evolve, and like we talked about before, no reductions, only increases where you can do it. So that's very appreciated. So just to wrap up here, Raj, I got a few just general questions. Rates are going down, right?
Mhm.
Interest rates are going down. Canada, the US has started as well. Trend is probably set to continue. What sectors you think investors should be looking at? What sectors in particular typically do really well when interest rates go down?
I mean, I think when you look up and down our lineup, during a declining interest rate environment, as we've talked about a lot of this already, but the banks tend to do well because people take on some more debt. They can now afford that mortgage or that loan. You tend to have fewer loan losses, so you don't have to write down as many loans because loans have now become more affordable for the investors. So it tends to play well for the banks. It plays well for utilities because Utility companies are very capital intensive and they borrow a lot for a lot of the infrastructure improvements that they need to do within their business. And so the lower rates means lower cost of carry or cost of borrowing. So that tends to have a positive impact on utility companies. Technology is the same, a little bit the same way. You have companies that are very capital intensive. They put a lot of money into their business. So when you have lower rates, you tend to have better performance within the technology sector. So QQQT, I think, should be well poised for that. And then lastly, fixed income. If you're typically going through a declining interest rate environment, that's positive for bond prices, which also means that it can be even more positive for longer dated fixed income. And obviously, our fund bond has 20-year US Treasury, which means that it's pretty long dated, which means that it typically should perform well in a declining interest rate environment. So those would be four quick ones within our product lineup.
Yeah, it seems like you got them all covered, right? You got the bond for the fixed income. Obviously, you have QQQY, QQQT for the technology. You have the UTES for the utilities. You actually have three relating to banks, to financials. You have bank, of course, which focuses on Canadian banks, call on US banks, and you even have EB&K, which focuses on European banks. So these, should be, like we discussed, sectors that benefit with rates going
And
down.
then, yeah, Adriana, and then the TSX 60 is obviously pretty tilted towards the banks as well from a
Yeah.
market cap. So yes, obviously it's not a bank specific or
Hmm.
financial sector specific, but you would get a little bit more diversification, but you'd also have some pretty good exposure to not just the banks, but also areas like the Canadian utilities as well.
Yeah, fair. That's a fair point for sure, for sure, for sure. So, Raj, you've been with me almost an hour. I really appreciate it, man. I know you're a busy guy. So let me just ask you one final question. Covered call ETF market or covered calls in general, it's exploding. Getting more and more popular, getting more and more mainstream. I'm hoping I have something to do with that. But why do you
Yeah, I think you do. Listen, I think you've been a
appreciate it?
great ambassador for the covered call space. I know that you have a lot of viewers, and I think you provide them with a lot of great information. So I think, yeah, well done to you. I would say that you're going to continue to see the growth in covered call
Why
funds
do you
for
think? Why? Why do you
well,
think that
for,
is?
for, for a couple of reasons. I mean, I believe that we're going to be in a lower interest rate environment next year than we even are today. We are obviously right now in a lower interest rate environment than we were last year. And when your rates start to come down, investors can't generate enough income through traditional fixed income, whether it be through their GICs or their high interest savings accounts and so on. And so in order to meet their income needs, they may tend to go out a little bit further and look at tax efficient yield from things like covered calls. So pick a sector or pick a broad market and generate some additional tax efficient income. So I believe that next year will be another. I would be shocked if next year doesn't break this year's record in covered call inflows because of that specific reason. And in addition, I mentioned earlier, I think there's been 51 new covered call funds that have launched this year. There'll probably be more, which means there's a lot of choices for investors. You want to express a view on a single stock or a specific sector or the broad market, it's there for you. You have the ability to invest in that with a covered call overlay. So you have more choice. And when you have more choice, you have more tools at your disposal. So I believe that that's the other reason why we'll continue to see a lot more growth in 2025 in this space. And then lastly, of course, the tax efficiency. That's a big driver, of course, but that's been a driver for years now. But as more and more investors become a little bit more concerned about tax planning, it's one of the few areas where you have tax efficiency.
Awesome. Raj, this has been really fun. It's been great. I can't believe an hour passed. It feels like just a couple of minutes talking to you. But very, very interesting stuff. So I encourage my audience, check out Evolve's lineup, evolveetfs.com. We talked a lot about the covered call ones, the covered call ETFs, but Evolve actually has quite a few growth-oriented ones as well, like QQQT, for example. But there's a bunch of other more thematic ones. So I encourage
We
you
have
guys to
crypto.
go.
We have crypto too, which is
Yeah, it's
obviously
true.
topical right now.
Yeah, which is just going on a rocket ship, but we know we could probably talk about that for another hour, so we'll
Sure.
save it
Yeah.
for another time. But Raj, thanks so much for your time. I really appreciate it, and I really, really hope that you'll come back on the channel to give us an update on what you guys are doing.
Look forward to it, Adriana. Thanks a
All right,
lot.
take care.
Bye-bye.